Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hello and welcome to Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me we have Mangalam as well as Rima, who's back from Japan. Hi guys, good morning. How are you feeling?
Rima, arigato, that's what they say?
Arigato gozaimasu. That's thank you very much. Okay. I can't believe I was away for 2 weeks. It just felt like I was away for a weekend, you know. But just like that, this whole first half of the year is coming to an end. And it's been one wild round trip for the equity market. So much has happened. It's been anything but quiet the first half.
This weekend, I have to tell you, was the first in so many where you didn't have to worry about which country is talking about another, which one has, attacked or made some statements which are attacking. Thankfully, this time around, all you had to look for were domestic cues, were foreign cues, things of economic, importance in nature as against any geopolitical. So that to that extent, that was a good weekend.
Well, weekend's always good, Mangalam. We've got a lot of action with regard to markets. You've got a big pharma deal as well that's been announced. So not short of action on that front. So let's get straight to it.
Let's get straight to it. And what a nice pitch this is for, all the batters, if you have to look at it, because the S&P 500, we're talking about how the Indian markets have done extremely well over the last 1 week or so. The S&P 500 has actually gone ahead and hit a fresh record high. In fact, this month itself, given all the uncertainty, given everything that's taking place in the world, the Dow is up nearly 4%, S&P 500 4.5%, and NASDAQ, the tech-heavy index, up around 6.1%. Even if you look at the other macros, they're fairly well behaved. The dollar index close to around 97. Chartists are speaking about, a further downtrend out there. The US bond yield is well behaved at 4.28, irrespective of the conversation that's taking place around Donald Trump and Jerome Powell. Brent prices also fairly contained at $67. Remember, it was just last week that they were closing in on $80, and now we're sub $70 itself. The key to track now from here on would be the negotiations between US and other countries. We saw a glimpse of the volatility around that on Friday. But the Dow was doing extremely well, and then Donald Trump went ahead and posted on Truth Social that all discussions with Canada have been terminated. But thereafter, we had the Commerce Secretary come and say the framework between US and China has been finalized, and they will soon reach, deals with 10 major trading partners. So all these factors are something that the street will be watching out for from a geopolitical standpoint. But from a US domestic standpoint, most definitely keep an eye out on the passing of the Trump's big, beautiful bill, which would increase spending out there. And if US does well, NASDAQ does well, what does well here in India? We've seen banks do extremely well. We've seen Reliance also pull back. It's the IT index that we'll be watching out for. As we move towards the start of the result season, the IT index about 15% away from a 52-week high. What do we hear from experts here? What does the global scenario look like out here? All of that, the IT index will have to do the heavy lifting around. Rima, that's about the global cues, but a lot of domestic cues too.
Indeed. But just quickly, let's recap what happened on Wall Street on Friday. Very strong finish. The S&P 500 and the NASDAQ surging about 0.5%. The Dow rallied 1% on Friday. The S&P 500 climbing to its highest level since the 19th of February. And the NASDAQ has reclaimed its record closing high for the first time since the 16th of December last year. The Dow is still about 2.5–3% shy of its all-time peak. The year-to-date, as Mangalam said, key indices in the US are up about 4–4.5%. But you know what stands out is this rebound that we've seen. Yep. In early April, I think 8th of April was the day when the US indices tanked on fears of the tariff. And since then, the rebound has been nothing short of historic. The S&P 500 is 24% up from its April low, and this marks the fastest recovery ever from a 15% decline, bouncing back in less than 90 days. Sentiment did turn a bit sour, as Mangalam was pointing out, on account of the talks with Canada. But what also added to the noise were the fresh attacks from Donald Trump on Fed Chair Jerome Powell, calling his performance lousy, suggesting he suffers from Trump derangement syndrome. That quote is up for you on your screen. Remember, US markets will be shut on Friday on account of Independence Day, so it's a truncated week on Wall Street this week. But as we look ahead domestically, Friday was indeed a very good session. Markets closing above 25,600, highest level since 1st of October 2024. 2% weekly gain. Nifty Bank fresh record high. And also what's important is that the markets, if you look at it, the intraday low on the Nifty has been higher for 6 straight sessions now. It's a bit of a signal of strength in the market. The big cues to watch, IPO Spotlight, HDB Financial Services. What a strong response. It's closed with nearly 17 times subscriptions. Listing will be later this week. On the M&A front, we'll talk about the Torrent Pharma JB deal. Auto sales numbers for the month of June will start trickling in from tomorrow, and the early feedback from Nomura's dealer check suggests that demand remains a bit soft with no meaningful pickup yet. So that's there. And not to forget, Q1 earnings updates will come through starting this week before we get the actual numbers from the IT heavyweights. But Nigel's moved over to the big world. What are the F&O Qs looking like?
Well, that's right. You know, we had a very, very strong close to the June series, and July as well has started off in style. And as we mentioned even in Friday's trading session, that seasonally, actually, July series has been very, very good for the bulls, both the Nifty as well as the Nifty Bank. And in terms of the Qs that we were looking at, well, the premium on the Nifty futures itself, that moved up a little bit, telling you that there are some long positions that are getting added out there. The question is, who's going to get to the fresh all-time highs first? Is it going to be the Nifty or is it going to be the small cap index? Because, you know, that as well is closer on 3.75% away, while you have, the Nifty that's 2.5% away from the all-time high. So both those two, the broader markets catching up is going to be interesting. And my gut is that maybe in the next 45 days or so, maybe the broader market actually outperforms what the Nifty does. What do the FIs do? Well, not too much on index futures, but on stock futures, there was some covering. So there was a swing factor of close to around 30,000 contracts. That is, they covered some shorts and there were longs that were added as well. In terms of positioning, well, they continue to remain net short, but not very aggressively. 62% of their positioning on the short side. In the past, we have seen 80% and we've seen 1 lakh contracts as well. So shorts in the system, yes, but not to a very, very large extent. Moving to the option Qs, the PCR. That's holding at around 1.25 odd. That's at closer to around the higher end of the band, but not to worry. You know, that's still moved up a little bit. But why is the PCR moved up? Because there is put writing that's come back in there. So we had the 25,600 put, 25,500 put as well. Fair bit of open interest added between the two, close to around 80 lakh shares. On the upside, we have the 25,900 call that's opened up, and there's a mix of activity. Those who are writing this particular strike, they're looking to pocket the premium of close to around 50 rupees or so. While the other out-of-the-money call buying it was evident as well. So mix of activity at this strike. But you'll have to say that these markets are in an uptrend. And you'll have to participate on the upside with your stop loss at lower levels until you have lower levels that will get violated. So the support level comes in at around 25,250. You have the 20 DMA, and then in fact you have the 50 DMA as well. So that's going to be the important marks that you're looking at. The support I'm talking about 25,250 because that was the resistance when we were trending up as well. And one stock that's really found its form is Reliance Industries. From the recent low, the stock is up close to around 30%. However, if you look at it over the last 1 year or so, it's still a little bit lower. So Reliance Industries getting to those highs of around 1,600 rupees odd, well, that would be key for the Nifty to get past fresh all-time highs and then head above the 26,500 odd mark. So this one's got the momentum. I think it'll have to lead from the front, giving company to the Nifty Bank as well as we trend higher.
Interesting, numbers there. Let's move on now to the equity calls then. It's Mahesh Nandarkar of Jefferies who says the sharp market rebound from March 2025 lows has triggered an equity supply response as expected. He says 75% driven by promoter PE exits. May and June, equity supply was over $17 billion. He adds, while the domestic flows have halved, improved foreign flows have helped. He says the supply pipeline remains strong, valuations elevated. He expects the broader index to move sideways but sees several bottom-up opportunities. He's overweight Bharti Airtel, financials, cement, two-wheelers and select real estate.
All right, with that, let's go across to Ed Yardini, who joins in. He's the president of Yardini Research. Ed, it's been a big rally that we've seen from the lows in the US markets. The streets now looking to live with this uncertainty that was there, and that uncertainty itself is, slowly coming down. What will be the two most important things that you'll be watching out for when it comes to trade negotiations and, at the same time, the big spending bill which has been lined up?
Well, I think with regards to trade, it's pretty clear that the administration would like to get this issue behind them. They are negotiating, and there will probably be some deals announced, some major deals, maybe even with India in the next several days, and that will be a positive for stock markets in the U.S. and India and around the world. I think that there will still be issues, perhaps with Canada, but what we're watching is negotiating. We're watching deal making. Deals will be done, and again, I think the administration recognizes that they'd like to get trade behind them, and they'd also like to get the budget behind them, and I think they'll certainly do that the way things have just gone in the Senate. I think the important thing to realize about the budget bill is that what it really does is it extends the tax cut that was already in place. Without it, we would have had a rather large tax increase that it could really have hurt the economy. I don't really view this bill as being particularly stimulative. It's just not going to be a situation where we're suddenly slamming on the brakes. So I think that the two big issues that the administration has started out with are going to become less pressing, less immediate impact on the markets. And I think the markets are going to, especially in the United States, going to turn to second quarter earnings. That second quarter earnings season will start in April. Let's do that in July. I'm looking backwards instead of ahead. So in July, we will get the second quarter earnings outlook, and that should be interesting. I think on balance, it'll be a positive one because earnings estimates have been cut back so much.
So Ed, on the whole, do you think the U.S. equity markets can move higher from here on? So far, despite all the noise in the background related to tariffs, whether it's the big, bold, beautiful bill, geopolitics, U.S. markets are at record highs. They've scaled back to those levels in record time. Just shows the remarkable resilience. So keeping that in mind, do you say more legs to go? Run.
Yeah, look, everything you said makes a great deal of sense. We have the market basically back to where it was on February 19th. The valuation multiple is around 22, which is where it was back in February 19th. We've got earnings estimates relatively strong. And so it's as though, nothing really happened between February 19th and now. Of course, a lot has happened, but it's been a V-shaped kind of correction. It's been, in many ways, a normal correction, certainly with a 18.9% drop in about 48 days. What's been remarkable, as you said, is how quickly the other side of the V, how quickly we've recovered from that correction. But I actually just wrote a piece saying that we could be looking at a melt-up scenario again. I and others were saying valuation multiples are kind of high back in February, and here they are kind of high again. So I think the market's going higher on earnings, but I can't dismiss the possibility that we'll see some irrational exuberance and see that the valuation multiple goes even higher.
Hi, Ed. Always good to see you again. So where do we go then on the S&P 500? I think we were talking about 6,500 or thereabouts.
Yeah.
If you're going to be going for a melt-up, how much higher can it go?
Yeah, well, my most likely scenario, my base case, is still 6,500 by the end of the year. Even that is awfully optimistic because the assumption is that the market will be discounting $300 a share in earnings next year with a multiple of about 22. So all that is optimistic. A melt-up would be a situation where we see the markets maybe still sticking with that kind of optimistic outlook for earnings, but getting up to 23, 24, 25 multiples, in which case we'll be looking at 7,000 by the end of the year, or maybe even more than that.
Okay, a quick word on the US economy, though. We had the PCE data that came out on Friday. Yep. That appeared to be pretty much in line. However, the core PCE number, that was a little bit higher. It looked a little bit hotter than what was expected. Right. Well, there are signs that, that there is some kind of slowing down if you look at the spending as well.
Sure.
How do you read the state of the US economy?
Well, it's kind of like tossing up a coin, and heads you win, tails you win. In the following sense, that if the U.S. economy is in a soft, in sort of a soft patch, something that's not going to last very long, and the economy starts to look better in the second half, which is what I think. I think the market obviously has been held down. The economy and the stock market have been held down by concerns and uncertainties related to tariffs. We also had that whole DeepSeek phenomenon that kind of rattled the market. Those issues are behind us now, and I think the market and the economy can do better in the second half of the year, and so that would take the market up on earnings. Now, if I'm wrong, and the economy is actually getting fundamentally weak here because the consumer's retrenching, well, then the Fed put is still out there. The Fed has been saying that they are no rush to lower rates. They've been stressing that they are fundamentally dovish. They are planning to lower interest rates. They're just not sure when. So if we get a weaker economy, they'll lower interest rates, and the stock market will go up on that still further.
That's a wonderful analogy there. Heads, you win, tails, you win as well. On the way up, you have the earnings that will take the market higher. If not, it'll be the Fed that will take the market higher. In any case, the market is likely to move higher, is what your call on the US markets is. Let's shift focus to the emerging markets, as well as your call, if you have any, on gold and the dollar itself.
Sure.
You know, we've seen weakness in the dollar as well as gold. Gold prices are about at their 1 month lows. Do you think the best of both of them is behind them? That's one. And secondly, if the US markets are doing well, what happens to emerging markets?
Yeah, let me cover those issues. Very important points. Emerging markets, I think, are getting a big benefit from lower oil prices. Certainly, India is getting a tremendous benefit from lower oil prices. So the bad news for the energy producers is great news for most emerging markets, other than the ones that export oil. So I think that's a big driver there. I think also the perception is that if this tariff issue gets settled sooner rather than later, that's also a positive, I think, for the global economy and for emerging markets. And they have been doing well. With regards to the dollar, I'm not bearish on the dollar. Everybody seems to be bearish. Maybe I'm being too much of a contrarian here. But the U.S. capital markets are the largest in the world. I don't think that the euro or the yen are candidates for becoming reserve currencies anytime soon. And I will not be surprised if we're pretty close to seeing a low in the dollar here. It's been really in a volatile trading range for a couple of years, so we're at the bottom of that range. If it breaks through down below that, I'll have to rethink what I'm missing. But right now, I'm not that bearish on the dollar. With regards to gold, I've been very bullish on the dollar, on gold, thinking we could get to 4,000 by the end of the year. And I think that's still possible. Right now, gold has seen some profit taking on the fact that geopolitical risks have come down a lot as a result of the ceasefire in the Middle East. But meanwhile, central banks of countries that don't get along very well with the United States are still committed to buying more and more gold in their reserves. And I think that keeps gold going higher. So I'm going to stick with 4,000 by the end of the year.
So if you get that right, you're positive the dollar, you're positive on gold, you believe that the gold prices can go to $4,000, and you're positive emerging markets as well.
Correct.
And you're negative oil.
Correct.
Got it.
And in emerging markets, you want to quickly tell us your view on India and if it's changed at all in the last few months?
Well, I think that India is sort of in competition with China when it comes to global investors looking for opportunities around the world. I think China's still got some serious problems here. We may see a resolution of just about all of Trump's trade issues, but the relationship between China and the United States is going to remain tense, and it's probably going to be reflected in ongoing issues with regards to trade. I think the relationship with India on a trade basis will probably be resolved very quickly, and we might get a deal here in the next week or so, maybe 2 weeks. I don't have any inside information on that, but the administration seems to be indicating that they're expecting some pretty big deals, and I think it would be a very big deal if we got a good trade deal between the United States and India. So I think India still looks pretty good. The market's benefiting from lower oil prices. China does as well. But India's got a much better demographic profile. The English language is widely spoken, whereas in China, not so much. But India is more of a capitalistic economy than is China. So I think India continues to perform very well.
All right, so India over China, right? Because the argument is that at these valuations, maybe in fact China could be the near-term story. What is your take on that? India's a structural story.
Yeah, I've been fundamentally opposed to investing in China, primarily because it's not a free market system. I think they were moving in that direction, and I think they embraced capitalism for a few decades, and that's why they made so much progress with their economy. But in the past few years, they've really clamped down on free market capitalism. They've been much tougher in regulating business. This doesn't mean that they can't continue to grow and succeed with technology in areas like that, but it's not an investable area for global investors in the sense that the rules can really change just overnight.
Ed, it's been a great conversation. Thank you very much for joining in. Let's also tell our viewers what we've lined up for you on our show today. So coming up first at 8:35, we'll break down the big pharma deal. Vishal Manchanda of Systematics Group will be joining in as Torrent Pharma is set to acquire JB Chemicals from KKR in 2 phases at an equity valuation in excess of 25,000 crore rupees. That's the big M&A deal we'll put the spotlight on. At 9 a.m., we'll be joined by the management of Texmaco Rail and Engineering as it wins a 535 crore export order. At 9:20, Mahesh Patil of Aditya Birla Sun Life AMC will be our market master for the day. At 9:30 a.m., the management of Indian Oil Corporation IOC will be joining in to discuss crude price volatility and the impact on the company. Following that, Sachin Agarwal of PTC Industries will be chatting with us at 9:40 to discuss their FY26 outlook. A little later, 9:50, William Sells of HSBC will join in to talk about the global trade uncertainty and how to position your portfolio. And finally, towards the end of the show, in our special segment, Economy Unpacked, Lata will be in conversation with Samiran Chakraborty of Citi India, Neeraj Gambhir of Axis Bank, and Srinivasan Varadarajan, banking veteran and market expert, to talk about how bond markets must read RBI's puzzling moves.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you today. We get to that in just a bit in our special Top 10 segment. But let's list out the companies first. Torrent Pharma, JB Chemicals and Pharma, Reliance, Bharati Airtel, Vare Energies, all of them will be reacting to positive news flow. Add to the list ITD Cementation, BHEL, Amber Enterprises. On the flip side, Jyoti CNC and Karnataka Bank will be reacting to negative news flow. Take that break, come back. We get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's a brand new week. The global cues are supportive. The GIFT Nifty should come up for you on your screen. But what about individual stocks? Let's get you the CNBC-TV18 list of top stocks for this Monday morning. And the first one is the big one in the pharmaceutical space, Torrent Pharma and JB Chemical deal. Ekta is here to break it down for us. Ekta, hi, good morning.
Hi, morning. Well, yes, the big deal is finally done. Torrent will be acquiring KKR's stake in JB Chemicals, and the total deal could go up to around 19,400 crores plus. Now, just to give you what Torrent will basically get from this entire deal is that they will in fact become the 5th largest pharmaceutical player in India. Their total domestic sales will rise by around 35% to around 8,600 crores plus in FY25. That's if you combine both the businesses. They will gain key chronic brands that basically JB Chemical sends So they have a strong presence, for example, in cardiac care as well as in gastro, and they will be getting brands such as Silacar, which is around 785 crores in terms of total sales, Metrogil, which is around 342 odd crores. They will also be entering the CDMO lozenges space because JB Chemical is one of the top 5 global players within that segment, so they will benefit from that. Remember that Torrent has a past track record for domestic focused M&A, so that's basically what they focus on. They had Elder in a couple of years ago, they had Unichem in around 2017 and Curatio in 2022. So all of these are domestic focused acquisitions that they've made, and JB Chemical, while it will add a flavor, it is going to be domestic focused for Torrent Pharma. There is a debt concern that it is likely to take on around 12,500 crores of debt to fund the deal. IIFL says the combined net debt could be around 14,500 crores. But remember that they also approved fundraising to the tune of 5,000 crores just in May 2024, just in May of 2025. So we'll wait and see what that works out like. Nomura says the adjusted EPS could rise to mid-single to low double digits. They have a neutral rating on Torrent Pharma. DAM Capital remains positive on Torrent. They say the 2 times EV to EBITDA leverage is not a stretch and the debt can be repaid in 3 to 4 years. Now, JB Chemical, will be interesting to see how the stock moves because the deal is at a discount. So technically, the stock should be in the red because it's an 11% discount to that 1,790 to the current market price and 8.9% discount to the open offer price. And the stock itself has run up very significantly. For example, it's up 398% since July of 2020. But IIFL says that the minority shareholders should wait for Torrent shares post the merger, and it's likely that both the stocks could probably move together. So it'll be interesting to see how JB Chemical moves, but for Torrent Pharma, it is a positive.
Big ones announced. Thanks a lot for that. Ekta will, in fact, we'll be getting an analyst later on in the show. Vishal Manchanda of Systematics Group will be joining in to give us his take on this particular deal. But Reema, you want to tell us about Reliance and Bharti Airtel? We had the telecom data that came over the weekend.
Yeah, so the TRAI data has come out with the telecom data for the month of May. And the big picture is that Reliance Jio is dominating share ads. Now, the total subscriber net ads in the month of May was about 21 lakh, 20.96. But Jio added 27 lakh, Bharti added 2.7 lakh. So between the two, they've added, 140% of the total amount. The problem is that some of the struggling telecom carriers, whether it's Vodafone Idea, whether it's BSNL, MTNL, they continue to lose subscribers. So in a nutshell, the big takeaway is that Jio is going very, very strong in terms of net subscriber ads. Even last month, it was the dominant, the dominant carrier in terms of net ads.
All right, net ads continuing for Jio as well as Bharti Airtel, the others on your screen losing share. It is the last day of the month, so a lot of paper will come in on sale ahead of the lock-in that starts before the result season. Hormaz joins in. Hormaz, you're watching Jyoti CNC.
Yes, on the final day of this block trade after the video closes tomorrow. And of course, there are certain...
Hormaz, we want to hear from you, but we'll come back to you in just a bit.
I think Hormaz said that my mic has dropped. Yeah. That's exactly what he's done.
All right, but I think for the timing, I think we'll hop across to Vama. Vamakshi joins us. She's got a few more stocks that are on her radar. Vama, it's a Monday morning. Smile. Be happy. Let's go ahead.
Good morning, Nigel. Let me first start off with BHEL. The company has received an LOA from Adani Power for 6 thermal units of 800 megawatt, and this order is worth 6,500 crores. So going with the green for this counter. Amber Enterprises, on the other hand, going with the green for this counter as well. The electronic division of Amber Group will be acquiring a majority stake in Power One Microsystems Private Limited. Keep in mind that this company manufactures battery energy storage systems, that is BESS, solar inverters, EV chargers as well as UPS solutions, and in FY24 they had a turnover of around 185 crores. Now this transaction will allow Amber Group to foray into the rapidly growing segment of energy solution, which bodes well. Lastly, keep an eye out on Karnataka Bank going with the red for this counter, and that is because the MD and CEO Sri Krishnan Harihari Sarma and ED Sekhar Rao have resigned. Mr. Sarma has cited personal reasons including decision to relocate back to Mumbai, and Mr. Rao too has submitted his resignation citing inability to relocate to Bengaluru among other personal reasons. So we'll be keeping an eye out on all of these counters.
Definitely keeping an eye out on all of those counters. Karnataka Bank top leadership resigning, but I think after the mic drop moment, Hormaz is back with us. and he'll give us a wrap of Jyoti
who's
CNC and a lot of the order wins that you're tracking as well. You want us to drop a beat or you will wrap it yourself?
That's not the mic drop moment you'd aspire to have on a Monday morning. But yes, of course, this of the final day of the block window before it shuts tomorrow as the new quarter begins. Watch out for Jyoti CNC. Well, certain non-promoter shareholders are planning to sell some stake here. The base size is around 1,200 crores. The upsize option is a 304 crores as well. So now, in case the upside option is exercised, that will amount to 6% of the outstanding in case that transaction is executed. And Jyoti CNC has been a sharp runner-up on the upside after this IPO in January last year. The stock is up almost 250% from those levels. So expect some supply here. Expect that stock to be in the red. But a couple of positive developments. One for Vari. It's won a 540 megawatt solar module order from the US. And that's a 270 megawatt supply this year and another 270 megawatts in 27-28. And the company had earlier also clarified that it is relatively insulated from that one big beautiful bill, which is potentially a headwind for these renewable and solar manufacturing companies, saying that it focuses more towards the utility side and not the residential bit. So expect that stock to open in the green. And ITD Cementation as well, a 580 crore order from Abu Dhabi, and that is for jetty construction works in the Runwal LNG project. So keep an eye out on these names. Lots of order wins. Expect that stock to open in the green as well.
Thank you. ITD Cementation has had a good month, 25% rally so far in June. Thank you very much, Hormus. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Torrent Pharma, JB Chemicals, Reliance Industries, Bharti Airtel, Vari Energies, ITD Cementation, BHEL and Amber Enterprises. Stocks with negative news flow are Jyoti CNC and Karnataka Bank. Moving on then, let's get a roundup of all the action from the world of commodities. Manisha is now joining in. Manisha.
Thank you so much for that, Reema. I'll start with the crude oil prices, where we are looking at prices trading a percentage point down in the Asian markets right now. And this is after crude oil prices falling 13% in the previous week as well. So Iran-Israel ceasefire seems to be holding, as fragile as it may be, and that's taken the premium off the prices. The street will also watch out for the OPEC and allies meeting on 6th of July, while there is an expectation that you could be looking at yet another increase in production by 411,000 barrels per day. So that is what the street seems to be working in with right now. But it's not just crude oil prices. When you look at the precious metal prices, we've seen a bit of a decline here as well. Gold is trading at around 1 month lows. Silver has come off its 12-year highs. What seems to be doing good, though, is the metal space. Copper still holding around that $5 mark. We've seen aluminum prices trade at a 13-week highs. Iron ore prices trading at a 1 month highs as well. So the industrial metals are doing well. So that means the risk on really seems to be working today.
All right, risk on seriously working today. We'll keep an eye out on all these commodities. With that, what we'll do is take a short break, come back on the other side, the big deal that was announced over the weekend, Torrent Pharma going ahead and acquiring JB Chemical and Pharma. We'll discuss more of that with Vishal Manchanda, who joins in from the Systematics Group to discuss this. Also joining us will be Prakash Diwan with some fundamental stock talk. Stay with us. Well, it's raining a lot of deals. On Friday, we got the deal in the paint space, and now there is a mega pharma deal which has happened between Torrent Pharma and JB Chemicals. Let's get in Vishal Manchanda, who's the analyst at Systematics Group, joining in. Vishal, the commonality between both these deals was they were done at a discount to the prevailing market price. From a Torrent Pharma standpoint, they've had a successful history of acquisitions. Do you see this as a positive? Or do you worry that, a deal this size, which they've never done before, could stress their balance sheet for at least the near term?
Yeah, I think this is probably the second largest deal we have seen in the branded Indian pharma space. Ranbaxy was the largest deal that Sun did. And I think after that, this deal is the second largest. So from a balance sheet perspective, I think the debt can go up to 2.5 to 3.5 times EBITDA. And if I look at the past, Torrent has been in that phase where they have kind of managed debt leverage to that extent, 2.5 to 3.5 times EBITDA. I think there is more certainty in such businesses that you acquire. So probably the leverage that you can take for such acquisition can be a bit higher than other transactions you would do.
Okay.
Vishal, the product portfolio seems to be fairly complementary. Both of them have a strong presence in cardiac and gastro. Can you tell us the impact in terms of cost synergies, the revenue synergies? How will Torrent Pharma's numbers change?
I think typically a number that one should expect post such M&A transactions would be 3 to 5% of the combined cost base is how I think about the transaction. So I think that should translate to about say 300 to 500 crores in synergies.
Right.
Okay, all right, Vishal. 500 crores of synergy benefits, right?
I think that would be an upper limit to that, a stretch for Torrent to reach to that number.
Okay.
Right. And by when do you expect this deal to be EPS accretive? Because if you're saying that, there could be a debt increase, then the interest component comes in, etc. 500 crore worth of cost synergies get taken care of. When does this deal become EPS accretive? What have you modeled in?
I think maybe FY27 or FY28. I don't have a model on Torrent or JB. I don't cover these names, but probably it should take 2 years to be EPS accretive.
And what could the revenue scalability of Torrent be, of JB be under Torrent?
So how I would look at this is what Torrent gets, unique things that Torrent gets from the transaction would be the ophthalmology portfolio in the India markets and the CDMO platform that Torrent gets. So they'll need to kind of build this larger, and ophthalmology in India there is large headroom for growth in that category, and probably Torrent gets a straight entry here. So that's good. And the CDMO platform, again, how well you execute is the question. There is always something. So the CDMO is always a large opportunity, and it all depends on how well you execute there.
Vishal's various brokerages are saying if the entire deal is funded via debt, it will be EPS dilutive even in FY27. But you're factoring in that 27-28 is when it turns accretive. Is that correct?
Probably, I think FY28 when it turn. So 2 years, probably it should be EPS.
2 years. Okay, one final question from my end. Would you, for the minority shareholders, would you recommend that they tender and participate in the open offer at a price of 16.39, I think? What would be the advice to the retail shareholder?
I don't cover either JB or Torrent, so I would refrain from.
But you want to give your initial thoughts on this question? How you would think about it?
So I think right now the JB share price is higher than than the price at which the tender offer would be placed. So it makes sense for someone to kind of exit now. At least JB can.
Okay. And what about the valuation at which this deal has been done versus all the other deals? Would you say it's fair value, or is it a better deal than what has been done in the past from a Torrent standpoint?
It's more or less at par with the other deals. So around 6 times sales and about say 20 on a trailing basis. If I look at the deal, it's about 23 times EBITDA on JV numbers, 24 times EBITDA of JV numbers adjusted for the ESOP costs. So I think it's a deal at par with other deals in the space.
All right. So the deal is at par with the others in the space, and you think that it is going to add around 100 crores worth of cost synergy benefit to Torrent Pharma. At the same time, the deal turns EPS accretive by FY27-28 at latest. At the same time, you do believe that 2.5 to 3 times debt to EBITDA is something that Torrent Group can somehow manage in the pharmaceutical vertical, right?
Right.
Perfect. Take your point. Thank you so much for joining in and giving us a quick read through of what this deal has been and how shareholders should look at it. Thank you, Vishal, for joining in. Let's welcome Prakash Diwan on the show right now. Prakash, you've heard what Vishal had to say about this deal, and of the 2 deals that happened over the last 2 days, one was JB Chem as well as Torrent Pharma. The other one was JSW Paint and Akzo Nobel. Which one do you think is a better bet in terms of shareholder capital deployment?
Good morning. Good morning, Banglam. It all depends on, so we are assuming that you're talking about existing shareholders in both these companies. So if I were an Akzo Nobel shareholder, does the deal make sense? To be honest, it does, because what happens is Akzo Nobel's plans to exit India have been, openly expressed for the last year plus maybe. And there are lots of things which are happening in the environment, the competitive intensity going up, and Akzo Nobel didn't really look at doing much in terms of leveraging their brand strength and their presence. But with aggressive player like JSW coming in, things could probably look up. They have the right to kind of be at least in the top three, which means it's Asian Paints, Birla Opus, and Akzo Nobel with the JSW bandwagon. So there are synergies which make sense to stay put. On the Torrent JB Pharma deal, it's very clear. JB Chem has been a very good wealth generator all these years. In fact, I think it's been about 5x in the last 3-4 years. And there will be some consolidation which will happen. Torrent, of course, has had a great track record in the past on inorganic growth. So you could get some sort of a comfort from that. But whether the stock really has an upside beyond this, the question is maybe, organically it could continue growing at about 15-18%. But there's nothing very spectacular that could happen just because Torrent's acquiring them. So, at the current levels, it probably makes sense for you to take a call on moving to something else, or wait for at least the consolidation and then kind of re-enter, is what I would feel maybe an ideal recommendation.
Okay, all right. Hi, Prakash. Good morning. Good to see you in. I want to ask you about the big boy Reliance Industries. Over the weekend, there were various unconfirmed reports that suggested that Reliance and Rosneft could be doing a deal out there, which could be a multi-billion-dollar deal. It'll be interesting because it could probably make Reliance the largest refiner in the country. And also, it will increase their OTC EBITDA by a large extent. The stock in the last 1 year actually is unmoved, but it's found its momentum in the last 3 months. At 1,500 rupees, what's your take?
Good morning, Nigel. So I've been a big believer in the Reliance story over the long period of time. They've kind of overcome setbacks, environmental, regulatory, seasonal, whatever you call it, and all new businesses that they have nurtured have kind of started reaching a stage of maturity. You look at the Jio numbers, I think, they added 10 times more than what Bharti's done with all the aggression that Bharti seems to be getting back. So Jio has done things more quietly. And I'm sure closer to the AGM, you'll probably start seeing an expectation build that there could be some announcements towards some sort of a roadmap on the listing, whether it's Jio, retail, whatever. But my sense is, and retail, by the way, retail is also doing exceedingly well. If you look at the ground reality of, what numbers add up, the kind of aggression they have started demonstrating in terms of faster delivery turnarounds and all of that. So I don't think there's any reason, and if this O2C thing is likely to come through, I think it will spur the stock to come back to its highs. And look at where the momentum of the market is. I mean, it's, Reliance carries almost 10% plus kind of weight in the Nifty. So if the Nifty were to do well, Reliance were to do well, Nifty has to do well. So it's like a cyclical thing. It's a self-fulfilling arrangement. You will see Reliance do well because the kind of buying that's happening is fairly large and it's institutional. And I wouldn't be surprised if the FIs have started to add to their portfolio. Till now, it's been under-owned in that aspect, and that's kind of probably changing now. I mean, I'm just looking at the numbers and the kind of volumes and delivery numbers that have been reflected on the screen. But fundamentally, I think Reliance definitely has much more space to go, because for the first time, all its verticals have started kind of maturing and performing and revving up to the optimal levels.
All right, and finally, before we let you go, Prakash, do you have a view on the oil marketing companies? Time to tank up. Oil prices are lower, and we don't have any near-term events like state elections, etc. So there could be a case for, prices to stay where they are. That means that's margin positive for them. Would you view this?
Absolutely. I think Manglam, this is one basket that will surprise everybody in the next couple of years, and I'm saying couple of years, not necessarily just the next couple of quarters. And notwithstanding the fact that this quarter number, June end numbers, they'll report a record profit just because of the kind of crude levels price levels that they have enjoyed. And you're right. Last year around the election in June, there was anticipation that the moment the elections are done with, you'll probably see some sort of a price, this thing change. That didn't happen. So all that margin is still sitting on the books, and this will continue. And the big bugbear out there was the LPG subsidies, which will start coming back to them in trickles, if it's not like a torrent, but which means that it'll keep adding to the P&L incrementally without much of outflows looking forward. So I think you need to just take a basket approach, buy all three of them, because all of them have their own salience, and at times things work differently. But for the next 2 years, I would be surprised if this becomes what happened to defense companies in terms of a re-rating. So there's a huge re-rating that's kind of anticipated, or which is likely, but you'll have to be patient with it because it won't happen overnight.
Prakash, do stay on. Need to slip into a very short break. But on the other side, we'll also get chatting about the market technicals. After a 4-day run, what are the charts suggesting? Will the momentum continue, or will we see a pause? Sudarshan Sukhani and Mitesh Thakkar will join in with a few trading ideas. Stay tuned.
Welcome back. Hope you're having a good morning. Well, the Nifty, the buy on dips continued even on Friday's trading session. But where are we headed from here? To help us out with that, we have Sudarshan and Mitesh to join us this morning. Good morning, gentlemen. Good to see you all in as always. Mitesh, you go first. What's the call on the Nifty? A mild uptick is what the GIFT Nifty is suggesting. But where are we headed from there?
Good morning, Nigel. So I think ever since we broke beyond 25,100 zone, I think I've been looking at 25,500 as the first target, and then 25,740, 750, which is where we had a gap when the markets were falling. I think that would be an area where I would be inclined to take profits. We've seen a good 500-600 point kind of a rally in the last few days, and there's a gap level, and we're also getting slightly overbought on the hourly and 2-hourly chart. So my idea is that while we may eventually go higher, in the near term, 25,750 will be a significant hurdle, and levels close to that should be used to take some profits on the long positions.
All right. And so, Darshan, you've been positionally bullish on the frontline index, and you said that, use every opportunity to go ahead and buy. Now that we are at levels where we are, do you think chasing this would make sense, or maybe again, wait for a dip and then add up?
Yeah, good morning. I would say that we've had the first leg of this up move wherever it goes, and the chances are that we will now consolidate and chop around for many days, at least for today, certainly. So there is no rush. If you have long positions, you can as well take profits because markets are uncertain in the best of times. Take profits on your long positions, wait patiently for either a sharp correction of 300 to 400 points or a protracted consolidation that goes for 2, 3, maybe the whole week. So till then, there is no rush to buy. So the way you put it was correct. There's no rush to buy. Take your profits and wait. But the only trade is to buy, not now, but whenever.
Okay. All right. Let's get to individual stocks then. Sudarshan, you go first. What's on your radar?
Well, the first is Torrent Pharma, which you've been talking about, and we had a big up move. Now that's a breakout. Now this is a positional trade. You don't have to rush to buy at the morning, but whenever you get an opportunity, go long, because that breakout tells us that significantly higher levels are coming. So with a stop under 3,300, consider going long in Torrent Pharma. Power Grid is a buy with a stop under 293. Pidilite Industries is a buy with a stop under 3,000. And Berger Paints is a buy with a stop under 570. It's an all-buy list as usual.
All right, an all-buy list. Interesting one on Berger and Pidilite. Paint stocks did well post the deal on Friday, and thereafter Pidilite, of course, for all of them looking to move away from the paint space but still stay in the home improvement space. Adhesives, Pidilite, as of now, Fevicol has no competition, so the street is looking at that. Raw material prices also fairly contained fundamentally. Mitesh, your individual stock picks?
Good morning. I have actually 1 sell and 3 buys. So on the buying side is Apollo Hospital with a stop at 72.50 for targets of 74.30. Laurus Labs, which made a fresh swing in a fresh 52-week and all-time high, is a buy with a stop below 689 for targets of 725. A sell call on Dr. Reddy's with a stop at 1316 for targets of 1265, and Deepak Nitrate is the final buy call. keep a stop bid of 1960, look for targets of 2010.
All right, gentlemen, thank you so much for joining in. We will come back to you for trades at 10 as well. With that, we'll take a short break. On the other side, we have the management of Texmaco Rail and Engineering. They won a near 530 crore order. What does that mean for their book and growth going ahead? We'll discuss with Sudipta Mukherjee, who joins in. Less than 20 minutes to go for trade. In fact, just a couple of minutes to go for pre-open as well. The GIFT Nifty is indicating a positive start for our markets after what has been a stellar week for the Indian markets and a good time for global markets in general, easing trade tensions, etc. GIFT Nifty, when we started the show, was up just around 15 odd points and now up 41 points, indicating that optimism is building on as we move towards the open for our markets itself. We do have Prakash Diwan still with us. Prakash, I wanted your view particularly on the auto space. Is there anything that you like here? You know, you have the auto sales data, which is likely in the next couple of days, and the Vahan data does not indicate a big jump that we've seen in the month of June. Do you think things can improve? If yes, then what are the stocks that one should benefit most from it?
So, quite difficult to hazard a guess, but you know, the data that we've seen possibly could throw up some surprises on the two-wheeler side with some of the players like TVS who haven't been doing very well because of some, you know, they launched a certain scheme for the dealerships. You know, they've revamped the discounting structure, the kind of, you know, working capital needs that they have from dealers and all of that. So that could have probably helped, but generally, by and large, June is not a month where auto sales pick up. It's only post the monsoon that things will probably look up, Manga. But in the, you know, in the shadow of improving OEM sales, what we could look at is some of the ancillaries which will do well. And what you need to look at is slightly long range. But you know, the notification that's come for the ABS in two-wheelers. Right now, it's only for 150cc, but now it's going to be next year onwards. It's going to be for all two-wheelers. And that means a company like Bosch could be probably a very key beneficiary because they sit right on the top of the value chain out there. So, you know, you will have certain moves like this which will benefit ancillaries selectively depending on the strengths. But I'm not too bullish on the OEMs at this point. And then you will have the likes of Mahindra and Mahindra battling it out with the Tatas on the EV side because their aggression is kind of getting into shape. But barring that, I don't think any fireworks that are expected out of the numbers tomorrow.
Prakash, on this issue of ABS being mandatory, possibly for two-wheelers, if that were to happen, will it not push up pricing and therefore hurt demand for two-wheelers? And keeping that in mind, how would you approach two-wheeler names?
Yeah, so there is always that fear. You know, it's very similar to when truck cabins were likely to get air conditioned compulsorily. There was a lot of protests. There were a lot of, you know, doubts whether, you know, the OEMs will be able to pass this off. But look at what has happened to a company like Subros in the last 1.5 years, right? I mean, it's kind of almost done about 200-250%. So this is something which takes time to get established. But if you see in the long run, people get used to a benefit and advantage that they're getting from a feature that's compulsorily added because it does increase safety levels. So what it does is it helps you set off potential damage costs that you would have if something goes wrong. And then it's, of course, safety, human safety, that's what you're paying for. But the scale that two-wheelers have, Rima, will probably not mean that the ABS is going to be very expensive. It won't be an incremental load up on cost very significantly. But I would wait to see how things pan out. It's, as I said, it's still a long duration. 1 year is still quite some time away. But it's very positive for the overall upgradation of quality of vehicles. And this will also help in the export side to a lot of the players that have already been doing it. But they'll probably be able to optimize the costs once this happens domestically as well.
Okay, all right. Prakash, request you to stay with us. For the time being, let's connect with the management of Texmaco Rail as the company has secured a big export order of around 535 crore rupees. To discuss this and more and what about the outlook from here on, we're joined by Sudipta Mukherjee, the MD at Texmaco Rail as well as engineering. Hi, Sudipta. Thanks a lot for joining in. Give us some color about this. What are the margins you will enjoy on this? Since it's an export order, are the margins better? And also there's a potential for another big order coming in there. What could that value be approximately? Just doing a rough calculation could suggest it could be 1,000 crore order.
Good morning. So far margin is concerned, it should be in the range of higher teens. And
it should be in the range of, so we missed that number.
I said that so far margin is concerned, it should be in the higher teens.
Okay.
That's what we expect. And if you see that it's a long-term contract, it's not only design and supply, but it also involves element of maintenance for 20 years. So we feel that this is a kind of, I think, one of the largest for an Indian company to have a rolling stock order from overseas market. Okay. And this market is predominantly led by Chinese companies and also some European entities. So winning such a large order definitely creates an opportunity for us to multiply this.
Sudipta? Yeah, Sudipta, if I got that correct, you said high teens are the margins, which are much better than what you're doing currently. Is that correct?
Yes.
And this is around a 535 crore order for supplying around 560 open-top wagons. That's right as well, right?
Yeah, it is right. And along with this, there is also a maintenance component into it because this has to be maintained over there.
How much would that be in terms of money for you?
So
maintenance contract?
230 crore. I mean, it's the 90% of the 95% of the total order book. And also it has a provision of further 1,040.
Yes. So that's exactly what we wanted to understand, Mr. Mukherjee. You know, one of this 535 crores, maintenance is 235 crores is what you're saying, right? And how long is the execution timeline on this? And on what basis are you likely to see that upsize for the deal coming in?
Okay, these 560 wagons has to be delivered within 24 months.
Okay.
The balance part is has to be supplied, of course, depending upon an outer limit of 5 years, which is comprising of 1,600 wagons. And of course, it's a turnkey project design and supply and maintenance. And the higher margin comes from the unique solution which we are providing, considering the track conditions and the reliability factor and the performance, which we are going to establish over there.
So by when will you know whether this deal has been upsided or not?
It should be done within these 2 financial years.
Okay, so these 2 financial years, you will, deliver goods worth nearly 240 crores. The remainder is spread over 20 years as operations and maintenance. And by the end of this second year, you will know whether this deal has been upsized or not. If the deal is upsized, how much bigger will the book be? How much bigger will your revenue be?
So it should be in the range of 1,500 crore, no less than that in Indian rupee. And we have full conviction of upsiding it because you know that particular continent. So there is a focus by the government and I mean the whole world is looking forward to because of various platinum category mineral availability. And this particular project is targeted for some bauxite mining. And other than that, there are so many other opportunities which is coming up and is a part of the larger scheme taken by the Cam Rail, which is the national railway in Cameroon. So we have a conviction that it has to come because it is a outer line of 5 years have been put because considering the progress of the new tracks which are coming up. There is another 512-kilometer tracks which are coming up in the country, connecting various cities and ports. So definitely seeing at the progress of that, these rolling stocks will be required, if not more.
With this international order, what would your order book now stand at? And what is the percentage of international orders?
So we have around 7,800 crore on a standing basis order book today. And if you see, it is around 10% of the total order book, which is of export order we are having today.
Okay. And are we seeing an increasing contribution from exports? Because the margins are clearly higher. You spoke about, I think, mid-teen, kind of high-teen margins for this particular order. Are all international orders with a similar margin of high teens?
Generally, yes.
Okay. And what about the contribution of exports? Do you see it going up from the current 10%?
Yeah, I would like to answer you in little bit elaborate in this, that because there was a question also that why it is higher. So these are not the commodity product portfolio where we are getting these orders from the export market, and whenever we work for the private markets also, which is unlike to the requirement or the supply which we do for Indian Railways. So these are niche products, and you need to design for a specific requirement of the customer. So there is a room for you to have a better competitive, higher margin pricing in a competition when you use technology and newer generation products or a specific boutique product to satisfy the customer. So, and in terms of the growth of the export market, we in Texmaco has a target that in next 3 to 4 years' time, our portfolio should have a 30% export component.
Okay, all right, 30%. All right, great. So that would mean margins as well trend up based on what you are saying, because they are commanding better margins. Let's talk about the near term, FY26. Let's just revisit those numbers. What kind of revenue growth can you do? What kind of margins? Last year, I think you did ballpark close to 5,000 crores. On that sort of a base, going by the traction in orders, what kind of revenue growth, what kind of margins you're looking at, and order inflow for the year? Please go ahead.
So in terms of the top line, we feel that we should have a decent 15 to 20% growth. But in the bottom line, we are targeting a EBITDA percentage near the between lower teen to mid-teen. So that's the immediate target for the company. And we have taken certain restructuring of the organization. That includes the demerging of the rail infra business to a wholly owned subsidiary. And with this focus, we feel that the core business of the company, other than the rolling stock, has a significant room of growth where you can see around 25 to 30% growth.
All right. So
you're saying margins in FY26 will be low to mid-teens, 13, 15%? But that's a substantial jump from the 9% margins that you had in FY25.
Yeah.
So what would, in 1 year, in 12 months, what can explain such a big jump in margins?
So it's basically the product portfolio, efficiency improvement, and focus on specific markets. Because if you see that historically, due to large order book of Texmaco from Indian Railways, it was in a range of 90%, and 10% market was for private and export. So our target is to change this mix without compromising in numbers to at least 65-35.
right. One issue that the industry was facing was that of lack of wheel sets, and that was impacting execution. Are you facing that as well, or are you fairly well, equipped with wheel sets for your growth going ahead?
For railway order execution, we are facing problem of wheel sets. So it is not fully resolved. And hopeful thing is that by mid of July, Indian Railway has been pragmatic to solve this problem forever. And we expect that from mid of July or end of July, things should normalize for the Indian Railway supplies. For private and export wagons, we are not dependent on this crisis. So we are well off to manage our wheel sets up, whatever we require.
How much of your growth guidance this year depends on the wheel set availability? Because if that does not come by July, say September, October is when it comes, then do you think your growth can be lower by a couple of percentage points?
We don't envisage that as of now, because you see that Texmaco has geared up very well last couple of years. And we focused on improving our capacity and capability quite significantly. And we have, I think, one of the most efficient production system in the country. Last year, we have delivered highest rolling stocks to Indian Railways and private sectors, so the largest manufacturer of the country, in spite of this wheel problem was persisting. And of course, it is little bit acute in the this first quarter of the financial year. But we believe that with our flexibility of production and large capacity, we'll be able to maintain and make up in next 3 quarters. And we do not want to give a different guidance than whatever I have said now.
Right. Just a final question from my end on your business diversification itself. We've seen you diversify into different geographies, whereas some of your peers have diversified into different product categories. Some of them have gone into rail infra, some of them are, making wheel sets themselves, some of them have gone into the metros, and some of them have gone into the defense space as well. Are you looking at these as diversification strategies, or do you believe that increasing exports is the way to go for Texmaco?
For Texmaco, the strategy is very clear and lucid. We are following a strategy of going deep as well as working wide. So whatever we have here, we have certain, in the core business, have certain key advantage which other peers doesn't enjoy in the country, being our presence and the certifications to supply to all the continents, our design and innovation capability, and our state-of-the-art foundry and components and the customer base. So there our focus is to increase our reach to newer markets and newer products related to the core business. And for the breakout business, yes, we are focusing. If you have seen that we have also got into the passenger mobility interiors, because we feel that the key ecosystem of the passenger mobility in the country, which is going to grow manifold, are one of the enablers to get into the whole product maturity cycle. And these are areas, are niche areas where Indian capability should come in. And along with this, we are looking for various wide opportunities, including various other component areas, digital spheres, predictive maintenance, and also certain things.
All right, we take that point. Thank you so much for joining in and giving us all your growth prospects for this year, but more importantly from a long-term strategy standpoint as well. We'll have another conversation soon. Wish you good luck with the execution of this order and the potential upsizing as well. With that, we're close to the 9:10 mark. Sudarshan joins in with his 9:10 call, as does Mitesh. Sudarshan, you go first.
Well, Power Grid, look to buy Power Grid with a stop under 293.
Mitesh?
I go with a buy on launch slabs for targets of 725.
Got that. Thank you very much for that. Let's get Ritu on the show now. She's going to get us the latest on Innocent Bank and JP Associates resolution. Ritu.
Well, on Innocent Bank, watch out for today because 30th of June is the deadline by which the Reserve Bank of India had asked the board to submit the candidates for the potential CEO position. We'd reported last week 3 contenders are in the running. Rajiv Anand, currently the DMD of Axis Bank, who's set to retire in August, would make him an ideal candidate and we're given to understand is very much a strong contender. Then there is Anup Saha from Bajaj Finance, again with more than 25 years in financial services, recently elevated to the position of MD in Bajaj Finance, and Rahul Shukla of HDFC Bank, who's currently looking after commercial and rural banking, but is on sabbatical, very much in the mix still. We're given to understand between these 3, Rajiv Anand and Anup Saha are the 2 names that the board is looking at more keenly. Informal discussions have already happened with RBI, but the formal names are yet to be submitted. We're also given to understand RBI may fast-track the approval given the urgency of the matter. As far as Jayaprakash Associates is concerned, we've reported There are 5 suitors.
Ritu, the bell is gone. The first tick is in the green, but it's a quiet opening. So after 4 days of a run-up, there is a pause in momentum. The Nifty is just up close to about 8 points. Sensex is moving between the red and the green line. Very, very quiet. But the mid-cap action continues. I think the mid-cap index is higher now for the 7th consecutive day with a gain of close to about 0.5%. The advanced decline ratio, the heat map, will also come up for you on your screen. So banks continue with their run-up. So a little bit of an outperformance, 100 points up on the Nifty Bank. It's IndusInd Bank right on top, the stock that Ritu was talking about. Today is the last day for the board to submit names of the CEO to RBI. IndusInd Bank is up. Jio Financials is having a good run. Axis Bank is gaining nearly about 0.5%, and in the PSU lot, it's State Bank of India in the green. Trend, Coal India, L&T, BEL, Eternal, ONGC. These are a few of the large cap stocks where you have a bit of green going for themselves. On the way down, Reliance Industries, HDFC Bank, the big contributors to last week's up move, are retracing some of the gains. Not down a whole lot, just down about 1/3 of a percentage point, but those two heavyweights are seeing a little bit of a profit booking. Two-wheeler names like Hero MotoCorp are under pressure. SBI Life, Bharti Airtel, Tata Consumer are some of the names which where at least the first tick is in the red right now.
All right, from the broader markets, well, a few stocks are calling for attention. Transrail, that one, in fact, is buzzing away. Big up move is what we're seeing on solid volumes out there. So that one should come up for you on the screen. SBFC as well, that's another name that's doing very, very well. Solid uptake on that name as well. Volumes quite high on these two. Last few days, we have seen that Lloyd Engineering has been buzzing around and volumes are large. So that is up another 2% on large volumes yet again out there. So keep an eye out on that one. Jyoti CNC, as the bottom of your screen is telling you, there was a large trade that was executed and that was on expected lines. We had reported that as well. 1.37 crore shares, which is 6% equity. Changing hands, total deal worth around 1,500 crore rupees. Massive volumes. Let's see. Sometimes, once this deal gets out of the way, you see some of these stocks bounce back. So I'll be interested to see whether or not that's going to happen in this case. Hind Rectifiers, couple of big order wins. The street likes it. That one is zooming away. It's up close to around 10% as we speak. Last quarter's numbers were good. Couple of deal announcements coming in there as well, and volumes picking up on this particular name. Keep in mind, it had corrected, I think, from around 1,700 rupees all the way to around 1,000 rupees, and that's bouncing back in trade. The Nifty, for the time being, well, that's a little bit lower, but plenty of stocks from the broader markets are doing well, and the broader market outperformance is something that's notable. Indra Prastha Medical, that's the other one that's up close to around 5%, massive volumes. Manglam.
The pair of the morning has to be JB Chemical and Pharma as well as Torrent Pharma. So Torrent Pharma mildly in the green, opened much higher, opened about 3.5% higher. Thereafter is now sitting with a gain of just about 1.2%. Whereas on the other hand, we have JB Chemical and Pharma. The deal has been done at a discount to its prevailing price. Even the open offer is at a lower level versus its prevailing market price. And that stock, look at it, down 6.5% straight off the bat, lower in today's trading session so far. Bharti Hexacom did extremely well towards the close of trade on Friday, but thereafter the stock has opened slightly lower. Some bit of profit taking is what the street is seeing out there. ITD Cementation, one orders. The stock has been doing well lately and now opens fairly in the green once again. The other stock which is doing well is VRL Logistics. So the stock has been on an uptrend ever since it reported its fourth quarter numbers, and since then, volumes are piling up. The stock opens up with a gain of almost 4% with decent volumes. And another stock which is coming up on the volume gainers list is Dreamfolks. All of last 2 weeks it was under a wee bit of pressure, concerns around whether key clients are sticking around with them or not. Dreamfolks is making a bit of a comeback. But Torrent Pharma is the one that I'm watching out for once again, because now it's lost about 3.5% from its highs. Let's see whether the street, is okay with the balance sheet upsizing of this deal and the debt that it brings. Or in the near term, there would be some EPS-related issues. But other pharmaceutical companies are doing a lot better. So we have Aurobindo Pharma, which has moved higher, up around 3%. We have Alembic Pharma, which has moved higher. And Pfizer, too, has opened about 2% higher. So pharmaceutical stocks, barring Torrent Pharma, which is mildly in the green, are largely doing well. And JB Chemical, of course, because of the deal price being lower, is down about 6%.
And Karnataka Bank, a couple of big resignations at the top. The stock is selling off. It's down close to around 4.5% as we speak. So that's the other one you should keep on your radar. 4.5% or lower as well.
Schloss, Bangalore, the owner of Hotel Leela, and Aegis Vopak, their 30-day lock-in comes to an end. So Hormus was saying for Schloss Bangalore, the owner of Hotel Leela and Resorts, about 5% equity is now available for trading. The stock is down about 2.5%. And I think some other names also he was referring to. There was Synoris Pharma, Sai Life, Stanley. Some of these, in some of these counters, there is stock now available for sale after the lock-in has come to an end.
I wonder what's taking place with Godfrey Phillips. That stock has been smoking hot. In fact, over the last couple of months, it's seen a big rally right now as well. It's up around 3.5%. In this month, it's up around 10%. But we've seen in this year itself, the stock is up 80%. The first half of this year, it's up 80%. And it's not that it didn't do well in the previous year as well. So if you look at it, the second half of last year, it was up 50%. At another 80% in the first half of this year. So Godfrey Phillips is one of the stocks which is spiking as we speak.
All right, well, let's welcome Mahesh Patil, Chief Investment Officer, Aditya Birla Sun Life AMC, who joins in. Hi, Mahesh. Good morning. Good to see you in. Markets appear to have got its mojo back and in style. Now the street is talking about, higher highs and, in fact, moving on in the upward trajectory. What do you think? Euphoria? Or do you think that it's very realistic? I think earnings is going to be the key determinant, and we'll get a sense of that in the next couple of weeks. But how are you feeling with regard to the Indian markets as of now?
Yeah, good morning. I think some of the headwinds or the clouds which are lingering around, right, on the geopolitical side, as well as on the tariff front, I think those are kind of now moving away. And that is giving a comfort that, I think the risks which were there are kind of coming off. And you've seen that not only Indian markets, but even the global markets. I mean, US market is now almost close to its all-time peak now, right? Where, in fact, there's a bigger concern, right, in terms of slowdown in growth because of the tariff impacts. So I think that is, now kind of behind. And overall, I think the liquidity flow into the markets is also improving. We've seen FIs slowly starting to come back. Domestic flows have been steady. And I think valuations were reasonable. I mean, markets after the correction, what we saw around 6-9 months back, a lot of stocks had come down to decent level. We've seen now interest coming back, not only into the frontline names. I mean, the large caps were always looking good on a valuation perspective, but even the broader market, right, the mid cap and small cap have seen a good recovery. Although I would say that it is more stock specific in the mid and small cap, not everything is moved up, but clearly, I think the confidence is coming back. And as we step into this fiscal year, we would see that the overall trajectory of growth, at least on the earnings front, should be better than what it was in the last fiscal year. More so in the, I think, second half, while the first quarter could still be a bit tepid because there has been some uncertainty on the global front. Companies have been doing a wait and watch. But I think clearly, with good monsoons also now coming in, we're expecting the sowing season has been good. So rural economy should do well this year, no? And that should support some amount of consumption also, which has been kind of lagging behind.
There's consumption which is likely to do well, sowing season, which implies that a lot of the domestic-facing names are likely to do a lot better. But, Mahesh, I wanted your views on the IT space because that is one index which is still a fair distance away from its 52-week high at a time when all the other indices are fairly close to their highs. Do you think the weakness is priced in and global situation is looking a lot less cloudy now than what it was, say, same time last year?
I would guess so, yes. I think the IT sector was the first one to underperform, right, earlier because of global concerns. And I think on that front, I think US, where you were expecting a recession, the probability was much higher around, say, 3-4 months back. Now that has receded. And looks like at least the commentary also from the IT companies is that the worst seems to be behind. That doesn't mean that you will see a sharp recovery over there in terms of volume growth. It will be still slow and tepid. But I think this is a sector where I think overall stability, I think, would be there. I think the downgrade cycle seems to be behind over there. Also, the cross-currency impact also could be slightly positive, at least in this quarter. And that should support. So I would say that this sector is now looking, while the stocks are not cheap, especially in the mid-cap and the small cap space in the IT is still expensive relative to the historical numbers. But I think clearly the headwinds there are behind. So I think if there is any positive surprise or slight change in the commentary, I think the stocks are probably ready to bounce from these levels.
So if you had to construct a portfolio, Mahesh, could you give us a broad sense of how you would do it with the preference and then the allocation to each of the sectors or themes?
So I think the allocation would be preference would be more towards domestic plays because global uncertainty, I think on the tariff front, while we've seen that, I think that might still prevail for some time. So domestic plays, especially as I said, the focused on the rural consumption. So we've seen that even some of these agrochemical companies are likely to report very good numbers in this quarter because volume growth has been strong. But as we move forward, right, we should see some of the discretionary consumption, especially as we move into the festive season, should do well. Rate cuts have happened, and we've seen the transmission of that happening pretty fast, and that should help some of the interest rate plays, especially say if you're looking at banking and financial, then the financial services, and the NBFCs in particular, I think should see a better growth not only but also improvement in the margins over there. So by and large, I would say a domestic focus, and on the external front, I would say sectors like say IT, for example, which have already underperformed and factoring a kind of so I think they could be a kind of a contra play to look at.
All right, the big story really, Mahesh, which has given confidence, particularly on the macro front, has been the sharp fall in crude oil prices. And it's, continued. There's no big view that's come in that crude oil prices are going to dance away to 100 anytime soon, even though we have geopolitical issues that cropped up. In that sort of a backdrop, what's your take on these OMCs? They appeared that at least as of now, valuations are in favor, crude oil prices are lower. How would you play this fall in crude oil prices? Will it be the OMCs? Will it be the paint companies because they stand to benefit, or would it be the FMCG names?
Yeah, so you're right. I think even with the worst of the, tensions which were there, we saw the crude price didn't go above $80 or so, right? And now with those things behind, I think the pressure on crude oil is fairly evident. And it looks like it will remain at these levels, right, around $60 or so. So given that, I would agree that the oil PSUs, oil marketing companies, are likely to see a better kind of marketing margins. Although the refining margins have also actually improved a bit. So I think all in all, I think the outlook there should look better. But I think you should also look at while crude oil prices have come down for the other sectors. It's also important to look at the demand side, okay, how that is shaping up, because unless the demand picks up, you will not see the benefit of crude price really coming in. Otherwise, they have to pass it on to the end consumers. So, but I think across the board, I think the inflation and this thing basket, I think should be lower. So I think that's good. And anyway, the macro, I think it is more important, right? Because we've seen that this last month, after many years, we've seen that the current account deficit, right, was in surplus. And that shows that it's a combination of not only crude oil prices, but also on the export side, remittances and this thing were also good. But I think that places India in a much more comfortable macro situation for stability. And that means good for flows, foreign flows into the economy.
All right, just look at Reliance. The stock has recovered a fair bit from the lows and actually taken the Nifty back into the green as well. It was mildly below the red flat line at open for Reliance as well as the Nifty. And if you pull up both the intraday charts of the Nifty and Reliance, you would know that they're fairly strongly correlated right now. Reliance has been leading the gains on the frontline index. Right now, it's recovered from the lows, and that's taken the Nifty back into the green as well, slightly above the flat line. I wanted your thoughts in particular on the consumer discretionary space, Mahesh, because a lot of people believe that urban weakness is also now bottoming out, and from here on, discretionary would do a lot better than staples because, that's where a lot of the incremental income would be deployed. So in light of that, say, hotels, Eternal, and a lot of these other new age companies, would you back them at these valuations?
I think the discretionary consumption, again, was weak last year. It is recovering. Still, the trends are not really very strong, but I think the two things. One is the rate cut, which should the transmission should start through, and that will mean that your disposable income could be higher. Secondly is the kind of a tax breaks which were given in the budget, right, for 1 lakh, total amount which has been passed on to the taxpayers. I think that will start to now flow in, and that will help the rural urban consumption, I would guess. So I think, as I said, mostly I think you should see the impact of that coming in into the second half, where it should gather momentum. And rural consumption is, as I said, with good sowing season, rural wages are in positive territory. Real wages are doing well, slightly than what it was in the last 2 years. So that should also spur. So I would say that consumption, especially discretionary consumption, retail companies, consumer durables, and the likes, I think could pick up. But it'll take time. It will not happen in the first half. I think you'll see that impact more in the second half.
What do you expect from banks in this earnings season? Because the latest reported system loan growth has been subdued. I think as of 13th of June, the loan growth was sub 10%, 9.6%, which is lower than the FY25 level. And plus, there will be the NIM compression that we will see on account of the rate cuts. So what's your expectation from banks? And if there is some weakness, would you go out there and add to any financial stocks? And where would your preference lie in financials?
Yeah, so banks this year, the outlook for overall growth is a bit muted in high single digits because, as I rightly said, because of the rate cut, you'll see an NIM compression. But I think there is some benefit coming in because of the overall CRR cut also. So the impact is not as high as one would have expected, considering that we have seen a 100 basis point rate cut, in the last 6 months, 9 months. Having said that, overall loan growth is, I think, the bigger challenge, as I rightly said, is in terms of the loan growth. In fact, last year, the concern was on the deposit side. Deposit growth was weak. I think that is now improving with overall system liquidity looking better. And banks have also been able to now cut rates, deposit rate much faster. So that should also help on the liability side, though the impact will take time to percolate through. So overall, I would say that the loan growth is the bigger this thing. I think and for that, I think we'll have to wait and see how the recovery happens, both on the retail side and even on the corporate side, because of the uncertainty. I think we've seen the corporates have been slightly hesitant in terms of pursuing with some of the capex plans. But as we get more clarity on the global front, I think you will see that also pick up. I would say that banks look good. Short term, this quarter, there could be slight, the profit growth would be slightly weaker, but I think one should really buy into this. We don't see any major structural challenge in the banking space. Continue to prefer the private banks. I think, though PSU banks are also looking good now because we've seen them underperform recently and the valuations there are fairly comfortable. But again, they would be more cyclical play rather than structurally. We'll still prefer the private banks.
All right, we take that point. Thanks a lot, Mahesh, for joining in and chiming in with your view on the market, the economy, individual sectors, and how they're likely to perform from here on. Seems like maybe the second half of this year a lot better given the favorable macros. The one consensus view that is building on right now, however, is that oil marketing companies are likely to do better as their margins will improve. So let's take it straight to the management of Indian Oil Corporation. We do have A.S. Sani, who's the chairman of IOC, joining us now. Thanks a lot, Mr. Sani, for joining in. A lot that's been happening, right, in terms of tensions. And the first thing that gets impacted is crude and crude supplies. That seems to have eased so far. But despite that, could you tell us how much has India been importing from Iran? How has the volatility impacted the spread so far? How's your business likely to play out from here on?
First of all, there was practically no impact of crude supplies during this last 10-15 days that the war was there, war-like situation was there. We have not been affected. As India, I can say that we have not been affected, not only Indian Oil. That is one point. The second point, you have asked that how much we import from Iran. No, we don't import anything from Iran. As far as my information goes, most of the Iran supplies go to China only. That is the second question. The third question is the price volatility. Yes, it went up in a single day by around $10 to $11 to a barrel also. But the good news is that as soon as the situation seemed to normalize, it has again come back to sub 70 levels. It is 67, 68, 65 levels, which are a comfort zone for us as Indian Oil and as Indian refiners, Indian OMCs.
So what's the crude breakup looking like right now, sir? Say for the industry and for your company. What's the sourcing mix?
Actually, it is a dynamic thing. You will understand it. But the question that you are asking with reference to Middle East, around 40% of my crude are coming from Middle East sources, and balance 60% is coming from all other sources, including Russia, including Western African countries, including the Latin American countries, and other sources, maybe some of it from US and Canada also, and other sources. So it is a mixed batch. Today, India per se and Indian Oil is importing crude from at least 38 to 40 countries. So it is a very well spread layout wherein we are not depending, or we are not putting all our eggs in a single basket. So we have a pretty spread out.
All right, Mr. Saini, if you could tell us what are the current petrol and diesel cracks? And if you compare it, say, with 3 months ago or 6 months ago, has there been a big swing out there?
Volatility, yes, of course. When these disturbing situations were there, it affected the gas oil, that is the diesel cracks more, because a lot of gas oil comes out of Middle East and it goes into other geographies. So there was a concern on gas oil availability for other parts of the world, not for India, but for other parts of the world. So it affected in a slight jump in the gas oil cracks. Gasoline cracks, the MS cracks, were more or less went unaffected, and they are the same as they were, like more or less in the same range as they were maybe 3 months back, or maybe say before war. So we can talk of before war and after war. Gas oil, yes, it jumped. Now it is getting somewhat subsided, but not totally where they were before the war. But gas oil, but the gasoline MS is more or less intact.
Right. I understand that qualitatively, sir, but if you could give us some numbers on that. What would the number of those cracks be? What levels are they at?
Around $7 to $8 for gasoline, and around $12, $13 for gas oil.
Okay. Sir, everyone's been talking about the new green energy push. What kind of capex from Indian Oil will go into green energy?
Capex, it is a long-term strategy that we have. We have a very laid out strategic plan going forward up to 2046, wherein we have an ambition of becoming net zero in our scope 1 and scope 2 emissions. And this plan of next 20 years, it has a layout of at least 3 lakh crores total investments. This 3 lakh crores investment is spread out over the next 15-20 years, which will go into the green energy initiatives. But at the same time, I would like to mention that all these investments that we are going to place in action in next 15-20 years will be based on the returns, because we see green energy, or we see the drive towards net zero as an initiative for increasing the profitability. It is not that we are just going to spend money. We are not going to spend money without the returns, because when we go for renewables, it gives me good returns. We expect to give good returns. Then we are going for green hydrogen. We expect that ecosystem will be developed, and then we will earn money out of it. Similarly, when we go into biogas or bioethanol or those things, we invest money into it with solid returns expectation.
Well, sir, you have a lot of expansions coming up, all across the country. Panipat, you have in Gujarat as well. Where do you expect, the one to come through as well, the Baruni? If you could give us some details with regard to your expansions.
My expansions are going to come on stream mostly towards the end of this financial year. maybe December 25 or by March 26. Most of them will be in very advanced stages of commissioning during this time period. That is one point taken care, and that will increase my refining capacities by around 20%, where I stand at around 80 million tons, along with my subsidiary, that is CPCL, that will go to almost 100 million tons per annum capacity. So that is one thing. The other thing that you about the battery, in battery, we are, first of all, we are in the value chain wherein it comes for EV charging stations. So we have, at least Indian Oil has around 14,000 EV charging stations spread all across the length and breadth of the country. That is one part of it. The second part is we are into battery swapping business. The battery swapping business, it comes in a JV with Sun Mobility. It is by the name of Indofast, and this in 3 or 4 geographies in India, around 1,000 battery swapping stations are already operational, and they are doing good business. They are. This is the play where we want to focus more at this point of time. Battery manufacturing, we are in talks with people. We are in talks for technology transfer with people. If that happens, we might go into the battery manufacturing area also.
Mr. Sani, you know, the one standing issue that's been the LPG compensation with the government. Have you been in talks with the government for any sort of under recoveries that we saw in FY25 for LPG?
Yes, we are in very positive talks. We have been given to understand that a big portion of it might come to us, and we are pretty confident of amply and adequately compensated for whatever is due for us.
Could you give us a sense of what timeline could this be and what the quantum of this could be?
No, timelines I can't assure, and I can't assure about the quantum also, but I've been given that they are considering our demands, and they are very much aware that it is all linked with what capex I have to do, how I am growing in my businesses, how I have to invest more and more into greener solutions and sustainable energy sources. So the capex is needed to be done. So that criteria is there in everybody's decision-making matrix.
All right, so one final question before we let you go. Give us an update on the refinery with CPCL, the Nagapattinam refinery. Will that also come up and give you that 100 million metric ton target that you've spoken about in the past?
The Nagapattinam refinery is, we have gone back on the drawing board because the viability of that refinery was not becoming very good. So now we have gone back on the drawing board and we are putting into more and more petrochemicals into it. So it might change the financial outlay, but it will be more of a petrochemical plant now going forward instead of a pure refinery play. So we are reconsidering our configuration, and again we will go back to our board for taking approval for that and then move forward.
All right, in that case, that will be an important one to track going forward when it comes to Nagapattinam. But more importantly, we'll watch out for, your cracks as well as margins going forward, along with volumes. And if at all there is any sort of recoveries coming in from the LPG under recoveries from the government, at what time, what quantum. Thank you so much, sir, for joining in and giving us your view on the company and the industry going forward. With that, we'll take a short break. But just before we do that, pull up the intraday chart of Alembic Pharma. It's been a big move out there, up around 10%. In fact, it's currently the top gainer in the broader markets with decent volumes as well. So we'll keep an eye out on why that one's moving. And the other one is Kalyan Jewellers. Remember on Friday, we did have Gautam Dugar join in from, Motilal Oswal did say that if gold prices stay stable, then it would benefit some of these jewellers in terms of demand over the next few years if gold stays stable for the next couple of years as well. And Kalyan Jewellers along with Titan stand to benefit. With that, we'll take a short break. On the other side, markets, the investment scenario with William Sells of HSBC joining in to talk about that and the global trade uncertainty.
Welcome back. Well, markets a little bit lower, par for the course after the kind of rally that we have seen, but a few stocks are doing a thing of their own. Jio Financial, that's moved to the high point of the day, and that's really been the big mover in the last couple of months. Reliance has done well, and Jio Financial, the share price derives much of its value from the holding that they have in Reliance Industries. Just take a look at that stock. Jio Financial last few months has outperformed what Reliance as well has done. But let's get in William Sales, Global Chief Investment Officer at HSBC Private Bank, and Premier Wealth, who joins us. Hi, William. Good morning. Thanks a lot for joining in. Well, what a first half of the calendar year it's been, right? We're drawing it, we'll be closing it down today. But you've had tariffs, you've had Trump, as well as you've had geopolitical issues. First, let's focus on Trump. Do you think we have experienced peak Trump in the first 6 months of the year? And in that sense, would it be good for US equity markets for the remainder of this year? Because there was some kind of uncertainty, but do you think US markets are now favorably placed for the second half?
Yes, we think so. We are overweight on US equities because of a number of factors. Firstly, when I talk to clients, and I'm just at the end of a 1-month roadshow here across Asia, and talking to you from Bengaluru, most clients are no longer for a recession nor stagflation, and that's obviously very good news. We ourselves are looking for 1.8% GDP growth in the US and 11% earnings growth in the US, so that's certainly a positive. I think with regard to the unpredictability of policy, what people have also realized is that we actually have two-way risks rather than only just one-way negative kind of risks. We've seen policy sometimes being adjusted when there was too much pressure from the markets or from business leaders, and clearly that's positively interpreted. So that basically explains why the market has rebounded, and we think it can continue to rally.
All right, so we have experienced peak Trump then in the first in the first half of the year, and the very fact that when the markets get a little bit jittery, he steps in. So that should be good times, right?
So yes, I do think that we have that positive momentum here going now, and it also illustrates basically that it is very dangerous to try to time the market. Staying in the market, so what we call time in the market, is important because obviously, as we all know, as Einstein said, compounding is the eighth wonder of the world. To try to be in diversified portfolios, but of course building resilience because we are going to continue to have policy uncertainty, lots of things hitting us, and that certainly will continue over the next 4 years, in my view. So therefore, staying in the market but building resilient portfolios.
All right. I was curious to know about your traffic experience in Bengaluru because the weather is great. They say that once you enter Bengaluru, first the weather hits you and then the traffic. I hope you did not experience that. Having said that, what about emerging markets? I see you being positive on China, Singapore, as well as India. In that, what would your pecking order be? And how much of an outperformance do you think some of these indices could do versus, say, the global markets, the developed markets, that is?
It's not to try to be diplomatic, but indeed we are overweight both on China and India and then also on Singapore. But they are very different types of markets. Obviously, valuations between India and China are very different, but the ROE is very different as well. Indian companies tend to have very high ROE. The Chinese are working on this and also working on distributing more dividends, being more shareholder friendly, and so on. In China, it is not the entire market that one can buy, I think. It is really, when we talk to our clients and to institutional investors, it's really the technology side that gets the attention, that people are positive about, and you can see, great progress there as well. But still, the domestic demand is still, a factor that needs to be improved on. We are expecting that the Chinese government will deliver more stimulus, but they don't want to do a big bang approach. They don't want to react to every single headline out of the US. They do it in a much more structural fashion. You started to see some improvement in that domestic demand, but clearly the deflationary spiral is still, is still a negative. So you don't see that in India. So when you buy China, I think it needs to be the technology sector and it needs to be those dividend payers. Whereas in India, we like the industrial side, we like the healthcare side, we like the financials as well.
Interesting point out there. But what about the Indian economy? Things seem to be moving in our favor. We have the Reserve Bank of India that's given us that growth booster shot. We have this currency that's fairly stable. And in fact, earnings are likely to pick up in this year as well. With that sort of a backdrop, do you think Indian equities can continue to do well from here on?
I do agree, yeah. So we expect 6.7% GDP growth this year, 6.2% next year, basically mostly driven by the consumer, who sees that falling inflation, indeed, that you're pointing out, in part because of the oil prices, the food prices, and so on. Obviously, it's helped by the rate cuts as well. We expect one further, interest rate cut. I've mentioned the sectors that we like. In terms of style, we would very much stick to the large cap companies because you see that the relative valuations are in favor of the large cap. The small cap have rallied potentially a little bit too much from a relative perspective, and the foreigners are going to stick with the large caps.
So you prefer large caps versus mid caps, and in terms of the sectors you liked, you said healthcare. I just missed the industrials, and what else?
And the financials as well.
All right.
In part to get that income as well.
What about the European markets and UK? You've made some changes to your portfolio there as well. So if one had to say make a global portfolio of $100, how would you spread that across US, Europe and emerging markets? And how much of that would come to India?
Yeah, so I know about the constraints, obviously, that Indian investors sometimes have, having a really globalized portfolio. But if you were to, be able to diversify, obviously, we always recommend that people do that. A lot of our clients have businesses, have lots of stakes here in India or in their home country. And we always try to have them diversify as much as possible because you don't want to double up on the country risk. So, try to diversify globally where that is possible. For the moment, in addition to the countries that I mentioned, India, China and Singapore, that we're overweight in Asia, we're also overweight in the US, which is, I think, an out of consensus call. More people try to go into Europe, but Europe has rallied already. The proof will be in the pudding as to how much of that fiscal spending and how much of the structural reforms, even more importantly, they will be able to do in Europe. I think in the US, people have relatively low growth expectations, relatively low earnings expectations. The positioning and the sentiment is relatively weak. So I think the earnings season in the US can be a trigger for companies to do better than expectations and therefore, to support a rally there. So an overweight for us in the US as well.
All right, an overweight on US as well as India, China, as well as Singapore. So that's the view coming in. Thank you so much, William, for joining in and giving us your call on the global equities and doubling down on your preference towards India in the emerging market space as well. As we slip into that short break, just keep an eye out on Siemens. That stock's moved to the high point of trade. A couple of these banks doing well as well. Bank of Baroda for one, and we have Federal Bank, which has spiked as well. And then we do have, Hindustan Copper, which too has moved to the high point of trade. We take a short break, come back on the other side. All right, before we take that short break, we do have PTC Industries, the stock on our radar after its wholly owned subsidiary, Aeroloy, has signed a memorandum of understanding with Safran Aircraft to co-develop aircraft engine components. To talk about this and more, we do have Sachin Agarwal, who's the chairman and managing director of the company, who joins in. Sachin, first up, if you could give us a scope of revenue generation via this MOU. What does this mean? Because you had told post your fourth quarter results that you already have an order coming in from Safran for a few, few aircraft. What does this deal mean in terms of, in addition to what was your deal with Safran earlier? What is the revenue scope here?
Good morning, Manglam. No, this is a bit different. The previous MOU and long-term agreement that we had signed with Safran Aircraft Engines was related to civil aviation, commercial aviation for LEAP engines. This is specifically related to military engines. So here the scope is quite wide. It's related to all titanium and superalloy and all critical material component manufacturing, as well as material supplies in various forms, right from billets, bars, sheets, plates. So it has a very, very wide scope. and has huge implications for India in terms of Make in India as well as the indigenous content requirements for the new policy that's coming in place.
What's the value of this? What's the potential value of this deal?
Well, that's a bit difficult to put in right now in terms of value of the deal, because it's right now in the form of an MOU, which will not translate like in the previous MOU that we signed with Saffron. The MOU was then later translated into a long-term agreement and contracts. So that stage will come probably in a year or so now from now. So then it will be a better point to give some value on this. But it has a huge potential, and it gels in with all the investments that we are currently doing in all these fields.
All right, Sachin, hi, good morning. Good to see you in. Thanks a lot for joining in. This is Nigel on this side. So you've given us few details with regard to this is military focused. The MOU is both for materials as well as for casting. And also you mentioned, I think it's going to be a mix of titanium as well as super alloy. Do we have any broad sense about which way it will be tilting towards? And what is the realization difference between the two, super alloy as well as titanium?
So normally in an engine, the weight is about split 50-50 between titanium and superalloys. In components, the valuation for superalloy is about in the region of almost, it ranges from almost like $400, $500 a kilo to almost $2,000 a kilo, or even going up to even $10,000 a kilo. So it has a huge range depending on the component. And similarly in titanium, it again in components it goes from almost $500 to about $2,000. In material supplies, it's also similar that in titanium we're talking about somewhere between $40 to $40 per kilo, all the way up to almost $200 per kilo, and on a similar range on the superalloys materials as well. So they're very similar.
Right. You know, this is one of the businesses that you've signed an MOU for. What about your other order book right now? I mean, where does that stand at? What is the visibility that you have? On this one, you said you'll probably get visibility, say, a year from now when it comes to value. As of now, with the orders that you have on hand, what kind of visibility do you have in terms of revenue for the next, this year and the next year?
So we currently have a reasonable amount of orders. We almost booked for, I think we in the region of close to almost having orders in the region of approximately 700 to 800 crores already in. We also expect that this financial year will be almost close to doubling our revenue from the previous financial year. So there is a very good visibility available in that sense. And then again, quite a significant increase the following year as well. So in terms of order book, we are very well placed. We have a substantial amount of capacities that are getting created, which will be unleashed in the financial year of 27. So again, then there will be quite a bit of increase after that as well.
All right. So for this year, we're looking at nearly, I think the last time around we'd spoken about this. This year you should end with in the vicinity of around 750 crores. That's correct, right? In terms of revenues?
Well, close to 700. I said almost double. So from the current financial.
750 crores should be a fair estimate. And margins in mid-20s?
Mid to high 20s.
Mid to high 20s. All right. But the bigger year, as you mentioned last time around, is with capacities coming on stream and with the order book, picking up pace. FY27 appears like the bigger year. So this year you double your revenues, and on that base you more than double your revenues, right? FY27 you should be looking in the vicinity of around 1,700 crores or thereabouts.
No, I think the primary unleashing will happen in the financial year 27-28 rather than 26-27. The reason being that a lot of qualification work that needs to be done on the new plant. So the plant will be up and running in about a year and a half from now, but the qualification work will start after that. So that will consume the next financial year to a certain extent. But but still from the domestic sources there will be still quite a bit of an increase.
Sachin, the rate at which your order book is growing, your revenue projections are, and at the same time you have been increasing capacities in titanium. We see that some plasma arc furnace, etc., going under trial production, etc. too. that has put a stretch on your working capital and your balance sheet, because I'm looking at cash flow from operations and that has been negative for the last many years for a company like yours. So we're just trying to figure out at what point do you turn CFO positive and what is your working capital outlook, working capital days?
So I think the working capital, I don't know which data you're looking at, but I think we have remained quite reasonably sustained on our operations. So there are two parts of our fund flow. One is related to the funding of the new plant, which is primarily going into investment in the new plant, which is in the tune of almost 800 to 900 crores currently ongoing. But on the operation side, we have remained reasonably well cash surplus, and which is also further getting funded or contributing to the investments that we are making. So the margins in this business, once the new capacities are released, are quite significant, especially in castings and the component business, where the margins, EBITDA margins, exceed 40-50%, especially also on a material side, where it's in excess of 30%. So with those levels of margins, I believe that there is no reason that we will be at any point cash starved in coming years.
All right, Sachin, just want to understand your working capital days. I think the goal is to get to hold it around 100 days. Is that correct?
That's correct.
That's the number you like to maintain. All right. Yeah. And since you have bulk of your expansion that will be coming in FY 26-27 onwards, for FY 29, what kind of a revenue number could you give? What is the aspiration? And since margins will improve from year on, how do you see the number, pan out from there as well? So let's focus on FY 29, since you'll have the capacities fully on stream and you have visibility. Please go ahead.
So 29-30, we are looking at reasonably in excess of 2,500 crores of top line.
Okay.
Probably touching somewhere around 3,000 even in 29-30. So in terms of margin, I think we'd be easily sitting above 30% positively. So quite a reasonably high margin, as well as very massive growth coming.
So roughly 750 to 900 crore EBITDA is what you could potentially do by FY29 is what you're saying, right?
Yeah, almost close to 1,000, yeah.
Yeah, it'll be interesting because
29-30, I said, so not.
Okay, as of now, your market cap is 22,500 crores. So clearly the street is looking ahead and saying that you're going to deliver blockbuster numbers. We'll hold you at this aspiration. Thanks a lot for joining in and giving us some color. Maybe the next time around, you'll be able to quantify this potential that you have from this MOU. Appreciate you speaking to us here on CNBC.
Just before we let you go, would you have a target on return on equity and return on capital employed? Because you are investing so much, these two ratios would be, pressured in the very near term.
But I think the numbers, as I said, 29-30, the numbers already kind of tell you what the kind of returns can be made. We are currently making investments in the region of 800 to 900 crores with potential EBITDA margins of in excess of 800, 900 crores incoming in the next few years. So that would give a very, very high ROE and ROC as well. Besides the agreement that we have just recently signed with Safran.
On ROE and ROCE?
Sorry?
Do you have a target on ROCE and ROE?
No, I don't have a target, but I do see a very high return.
Got that. Take your point.
And besides this agreement that we signed, in the next few months, we are signing many more agreements to come in the next 6 months. So which will keep you informed on that.
All right, take that point. Thank you so much for joining in and giving us your outlook on the business. With that, we'll take a short break, come back on the other side. Manisha Gupta joins in with focus on all things commodities. Welcome back. Let's get trades at 10. We have LIC, which is doing well. RBL Bank higher as well. And we are seeing some traction in all the PSU banks this morning so far, even as the frontline indices are slightly contained. Mitesh Thakkar joins in. Mitesh, what would your trade at 10 be?
In fact, Mangalam, I have LIC as a recommendation with a stop at 964 and a target of 1010. And the other one is State Bank of India. It's looking good as well. Buy here with a stop at about 805 and a target of around 840.
All right, LIC and PSU Bank, you have SBI as well as LIC as your pick. Thanks a lot for joining in. With that, let's shift focus to the commodity space. Manisha, what's the one commodity that you're tracking today?
Well, I actually want to take a look at all the commodities for the month of June because it has been quite an interesting month. But yes, I'll put in focus crude oil prices first because this clearly has been the most volatile of all. And it is trading nearly a percentage point lower in the Asian markets right now after nearly 13% of a decline in the previous week for the crude oil prices. Well, a 13% decline has been the sharpest weekly decline that you've seen in 2 years coming for the crude oil prices. One, it is about the Iran-Israel war, as fragile that ceasefire is, but it seems to be holding, and that's taken the premium off the markets. The second thing is that you have to really look at the volume, or rather the volatility that we've seen in crude oil prices. The 12-day Israel-Iran war had the crude oil prices surging all the way up to $80 a barrel. And then we saw correction come down to 67 a barrel. And that's exactly where we seem to be trading at this point in time. The other thing that the street will watch out for is the OPEC Plus meeting. Well, that's on 6th of July, where they decide on what is going to be the production for the month of August now. The expectation is that they will increase it by 411,000 barrels per day. And they have been actually doing this for the month of May and June and July, and could be happening for August as well. This actually would be a fifth monthly increase in production that OPEC could be doing. And that's yet another reason that you have seen prices talk about a supply surplus of almost 1 million barrels per day in this year. And that's weighing onto the markets too. A couple of things which actually could be supportive is one, the China-Iran crude imports, which hit a record high for the month of June, could see more gains coming in the future months as well. The second point is about the US oil and rig count, which also has seen a decline by a fifth straight month this time around. And with that, the actual count of US oil and rig now stands at the lowest since October 2021. So barring these two factors, everything else seems slightly bearish for the crude oil prices from where we stand. But I do want to take you through on what we've done in month of June for many of these commodities. And I'll start with energy, where we are looking at a second monthly gain for the crude oil prices, up by 5%. Natural gas has been the only one that has seen a decline. Otherwise, heating oil, gasoline prices actually have seen gains for the month of June there. Take a look at the precious metal prices there. And here you see a sea of green. Barring gold, where we haven't seen any safe haven buying, the money actually came out of gold and went to various other metals. So silver is gained up by 4% for the month of June, but the actual outperformance comes in from platinum and palladium, 14% up for palladium, 28% of gains coming in for platinum as well. And my final plate will show you the base metal prices, where we have seen the outperformance come in from copper, 4.5% of gains in the month of June. We've seen stronger gains from aluminum at 5%. Actually, metals have seen a good month for the month of June. Barring steel, which also seems to be easing its losses there, we've seen a stronger month there. And the markets do believe that base metals perhaps is the way to get into for the month of July as well, with slightly longish positions there.
All right, base metals is the way to go. Thank you, Manisha, for that. All things commodities. With that, we'll take a short break. On the other side, our special segment, Economy Unpacked. Lata will be in conversation with a battery of people. There will be Samiran Chakrabarti of Citi India, Neeraj Gambhir of Axis Bank, Srinivasan Varadarajan, who's a banking veteran, and a market expert on how the bond markets must read the RBI's puzzling moves.